Welcome to the deep dive. If you're like most investors trying to guess future stock returns based on, well, past ones, it feels like flipping a coin.
Uh-huh. Pretty unreliable.
So today we're going to get into a much sharper method, looking at what the market itself seems to be expecting right now. We're moving beyond that noisy historical stuff.
Yeah, we're talking about the Market-Implied Equity Risk Premium, or ERP for short.
ERP. Okay.
And the key is, this isn't backward-looking at all. It's like you take today's stock price.
Right now.
And you figure out the exact discount rate, the return that the market needs to justify that price, given all the cash flow it expects down the road.
So the price is kind of telling us the required return investors are demanding today.
Exactly.
And we need this because just looking at, say, the S&P 500's last 50 years, well, that ignores today's valuation, doesn't it? And that whole U.S. survivorship bias thing.
Yeah, absolutely. Yeah. Past success doesn't guarantee future returns, especially if prices are already high. So, the framework we use is a pretty standard, robust one, a two-stage cash flow discount model. Think Professor Aswath Damodaran.
Okay, Damodaran's model.
And crucially, when we talk cash flows, we mean total cash back to shareholders. So dividends plus share buybacks. Very important.
Got it. Okay, let's unpack maybe the core assumption here. The model makes this long-term growth rate like way out in the future.
Yeah, the second stage growth, G2.
It sets that equal to the long-term risk-free rate, like the 10-year Treasury yield.
Yeah.
That sounds kind of conservative, doesn't it? Why that specific constraint?
Well, it's really about economic logic. Think about it. Can the entire corporate sector, like all companies, grow faster than the whole economy forever?
No, probably not. It eventually become the whole economy, which doesn't make sense.
Precisely. So that constraint forces some realism. It stops the model from just assuming growth goes to the moon indefinitely, which, can mess up valuations.
Okay, that structural realism, that's where it gets really interesting then. Does this ERP thing, does it actually, predict anything useful, any aha moments from history?
Oh, yeah. Big time. It acts like a dynamic valuation gauge. Remember the year 2000, peak of the dot-com bubble?
Oh, yeah. Crazy times.
The implied ERP hit rock bottom. It was around 2.05%. Super low.
And that meant?
It basically screamed overvalued. And sure enough, what followed was the lost decade for stocks. Basically zero, even negative returns.
Wow. Okay. What about the flip side? When it's high.
Exactly. High ERPs signal potential undervaluation. Like back in 1979, the ERP was up around 6.45%. What happened next? Almost 15% annualized returns for the next decade.
Huge.
Same thing, pretty much. In March 2009, bottom of the financial crisis, ERP hit 6.43%. And then, a very strong recovery followed. Quantitatively, there's a solid plus 0.5 correlation between the ERP and the next 10 years returns. Historical data. That's actually negatively correlated.
That's a massive difference. Okay, so if the signal's that powerful, what if you tried to, trade on it? We looked at a simple strategy. If the implied total expected return, the ITR.
Which is basically the risk-free rate plus the ERP.
Right. If that ITR was higher than just the risk-free rate, stay 100% in stocks, say VTI. If not, flip to cash. How did that actually perform?
Okay, so the back test, we ran it from 2001 to 2025. And it showed a really classic trade-off, the tactical switching strategy. It actually made slightly less money overall, like 8.9% per year versus 9.3% for just buying and holding VTI.
So about 40 basis points less return per year. That's the price you paid. But what about the risk side? How did it handle the big crashes?
That's where it really shone. It won hands down a risk-adjusted return. The Sharpe ratio was way higher, 0.53 versus 0.40 for buy and hold.
Okay, much better risk-adjusted.
And the key reason, drawdowns. Buy and hold got hammered, down over 55% at its worst. The strategy, it cut that significantly. Max drawdown was only about 38%. It really cushioned the portfolio in 2008 and again in 2020.
So less absolute return, but much, much smoother ride and better capital protection. Okay, let's bring it to today. As of, say, September 30th, 2025. What's the model telling us now for a global portfolio, like Vanguard's VT or VTW ARX?
Right now, based on current inputs, the implied annualized total return for that kind of global fund is looking like 8.86%.
8.86%, okay. And for the U.S. market alone?
The U.S. ERP is currently about 4.33%. Its long-term average is around 4.25%.
So pretty much right on average.
Yeah, it suggests the U.S. market isn't flashing red for expensive or green for cheap right now. It seems, reasonably valued based on this framework.
And that's the real strategic value here, isn't it? It's not just about trying to time tops and bottoms perfectly. It's about setting realistic, data-driven expectations for your financial plan, moving past the noise.
Exactly. But, it does raise an interesting point to think about. While the framework clearly helped manage risk, especially downside risk,
Right.
it doesn't actually lead to the highest possible end wealth in that backtest because it missed some upside.
Yeah, that slight return drag. So here's a final thought for you, the listener, to chew on. If you see this implied ERP getting persistently low, signaling potential overvaluation, how might using that signal just for your annual rebalancing, maybe slightly reducing equity exposure, then differ from using it as a trigger for a full-on, high-frequency tactical switch in and out of the market? Think about the friction, the taxes, the potential whipsaws of each approach, something to consider.